America just seized an Iranian oil tanker worth over $100 million in cargo, and China is furious. But here's what nobody's telling you. This wasn't just a military move. This was a financial weapons strike, and it may have just cost the United States far more than that oil was ever worth. Stay with me, because by the end of this video, you'll understand the one miscalculation that could reshape global oil markets for the next decade. Let's start with what actually happened. In early 2025, the US Navy intercepted an Iranian supertanker in international waters. The cargo, roughly 800,000 barrels of Iranian crude oil. At current market prices, that's somewhere between $60 and $80 million worth of oil. Seized, gone, transferred to US custody. Washington called it sanctions enforcement. Tehran called it piracy on the high seas. And Beijing went completely silent. Which, if you know anything about how China operates, is actually the loudest thing they could do. Now, to understand why this matters financially, you need to understand one thing. Iran and China have a 25-year, $400 billion cooperation agreement, signed in 2021. Under that deal, China buys Iranian oil at a steep discount, sometimes 30 to 35% below market rate. In exchange, China pumps billions into Iranian infrastructure, ports, railways, and telecommunications. That seized tanker wasn't just carrying oil, it was carrying the lifeblood of that entire partnership. So when America grabbed it, China didn't just see a foreign policy incident. China saw someone reach into its wallet and take money directly out of it. Here's where the financial strategy gets really interesting. Trump's sanctions campaign against Iran is built on a concept called maximum pressure economics. The idea is simple: strangle Iran's oil revenue, collapse the Iranian rial, force the government into a corner until they negotiate on nuclear terms. And on paper, it's worked before. Back in 2018 and 2019, Iranian oil exports dropped from roughly 2.5 million barrels per day down to about 300,000. That's an 88% collapse. The Iranian economy shrank by over 6% in a single year. But here's the problem in 2025. That strategy assumed Iran would be isolated. Iran is not isolated anymore. China is now absorbing somewhere between 80 and 90% of all Iranian oil exports. They're doing it through a shadow fleet, tankers with falsified documents, ship-to-ship transfers in international waters, and shell companies registered in third countries. The US Treasury has sanctioned hundreds of these entities, and every time they sanction one, 3 more pop up. It's financial whack-a-mole, and it's costing the United States real money to play. Each naval interdiction operation cost the U.S. military an estimated $2 to $5 million. Legal proceedings to adjudicate seized cargo can drag on for years. And the diplomatic fallout? That's harder to put a number on, but trust me, it has a price tag. Now let's talk about the red line China actually drew. In March of 2025, Chinese state media ran a piece that was unusually blunt. It warned that any continued seizure of vessels carrying Chinese contracted cargo would be considered a hostile economic act. Not just against Iran, against China. That's the red line, and America just stepped right over it. The financial consequences are already showing up in the data. Chinese purchases of U.S. Treasury bonds have been quietly declining. China currently holds somewhere around $775 billion in U.S. debt. That number has been dropping. If Beijing decides to accelerate that sell-off as a financial countermeasure, U.S. borrowing costs go up. American taxpayers feel that. We're talking about a situation where seizing $80 million in oil could trigger a bond market response, costing American consumers billions in higher interest rates. That is the definition of a miscalculation. And it doesn't stop there. Iran has responded by threatening to close the Strait of Hormuz. Now, we've heard this threat before, but in 2025, the threat carries more weight than it used to. Here's why. 20% of the world's oil supply passes through that strait every single day. That's roughly 21 million barrels. If that waterway gets disrupted even partially, global energy markets go haywire. Goldman Sachs estimated in a 2024 risk model that a 2-week Hormuz closure would spike oil prices to $150 per barrel, maybe higher. Who gets hurt most? Europe and Asia. Who benefits? American shale producers, who suddenly become the world's emergency gas station. So there's a cynical financial logic here that you have to acknowledge. A Hormuz disruption is actually good for segments of the American energy industry. Is that a coincidence? Maybe, maybe not. But here's the backfire nobody saw coming. Russia, Iran, and China have been quietly building an alternative oil payment system, one that bypasses the US dollar entirely. They're settling trades in yuan, in rubles, and even in some cases, using barter agreements and gold-backed instruments. Every time America weaponizes the dollar, seizes assets, or squeezes an adversary through SWIFT, it gives these three countries more motivation to accelerate that alternative system. The US dollar's role as the world's reserve currency is the single greatest source of American financial power. It lets America borrow cheaply, sanction enemies, and project power without firing a single bullet. If that status erodes, even by 10 or 15%, the cost to ordinary Americans is measured in trillions. Not billions, trillions. And Trump's piracy strategy, whatever its short-term wins, may be speeding up that erosion faster than any enemy could from the outside. So here's where we land. America seized an Iranian tanker, enforcing sanctions it has every legal right to enforce. But in doing so, it handed China a propaganda win, accelerated a de-dollarization movement that threatens American financial supremacy, and pushed oil markets one step closer to a volatility spike that could hurt the very American consumers this administration says it's protecting. The oil in that tanker was worth $80 million. The geopolitical price of taking it, still being calculated, and the numbers aren't looking good. Now I want to hear from you, and I mean actually argue this one out in the comments. Is Trump's maximum pressure strategy a necessary financial war that will ultimately force Iran and China to the table? Or is it a short-sighted move that's accelerating the end of American dollar dominance and handing the real victory to Beijing? Drop your side below. Let's see where Warfinex stands.